Thanks for joining us today. My name's Sean Ellis. I'm the General Manager of Strategy and Growth at Vision Super. Joining me is Tim Ridley, who's our Chief Investment Officer, Deputy Chief Investment Officer. Just giving you a raise, Tim. Congratulations. Tim joins us to talk in the series of updates we provide on our investment performance and what's actually happening in the markets. And we've been led today from a few questions we've received from members. We'll kick off with the first question. Over the last few months, we've seen member balances decline in market volatility. Can you give us some sort of expectation on what we're expecting markets to do and bounce back, but then also in turn, what that'll mean to member balances?
Yeah, Sean, it's been a really challenging 2022 so far. And in answering your question, I think a key aspect is actually knowing why markets have fallen. So in that context, the key reason is inflation. Inflation has been high this year, much higher than has been targeted by central banks. Central banks are pushing interest rates up. And as a consequence, valuations of things like equities are falling. So the focus of central banks is to reduce inflation. When the inflation outlook improves, what you're likely to see is the markets bottom and improve thereafter. In terms of where we're thinking markets will improve from, it's probably the next 6 to 12 months we'll see a bottom in equity markets. Most likely our best guess is within the next 6 months. So some further downside because there's still some tightening to cut. So interest rates are still increasing at the moment. But we anticipate that within, say, 6 months or so, you'll probably see a bottom in equity markets. And if you look at historic comparisons, typically when the markets fall, they fall over a 12 to 18 month period or less than that period. So that time frame does fit well with our historic experience as well.
Thanks, Tim. Great response. We've seen, and as you've just spoken about, we're seeing markets decline and probably in the next 6 months start to reach their bottom. Some members talk to us about market crashes through that context. So can you tell me what Vision Super is doing to protect member balances?
Yeah, it's a very good question. What we do is we have two broad strategies. One is diversification. So we anticipate from time to time markets will have adverse periods like they have done in 2022 to date. So we design the portfolio with that in mind. So we use diversification. So that's at 3 levels. Firstly, across different asset classes. So our multi-asset class investment options have exposure to a range of different asset classes. So Australian equities, international equities, infrastructure, property, cash, and so forth. So there's a range of different experiences across those asset classes. And when we aggregate them, we tend to get a more diversified outcome. So you don't get the full effect of equity markets falling as they have done this year. You get a cushioning because of that diversification. We also have the diversification at the manager level. So within asset classes, we use a number of different managers and they have different styles, different ways of investing. That gives a diversification. And the other third dimension is the investments themselves. So we have a lot of different individual investments. So when we aggregate the portfolio, there's a lot of diversification. So as I mentioned, when equity markets fall sharply, you don't get the full brunt of that fall in terms of the portfolio performance because there's offsets. Some things will perform better, not fall as far, and some things will actually experience positive returns. For example, infrastructure's had positive returns this year, while equities has been negative. The second dimension relates to dynamic asset allocation. So what we do there is we look forward and ask the question, what is the most likely outcome in terms of the investment environment and also scenarios around that. And we position the portfolio for the central case, and also we do capture the scenarios to some degree. At the start of this year, we anticipated equity markets would fall, and they have, and that's through reducing equity exposure. We've added some performance to the portfolio, i.e. we've reduced the downside for the multi-asset class options through having less equity exposure. So that's an important aspect that we implement over time to add a bit of value to the portfolio through time.
And so, Tim, we're getting regular questions now, and I'm reading it in the media around a recession. Are we headed for a recession? And what does that mean for superannuation balances if we are?
Sure. In terms of our central case, we anticipate the US will be in recession next year. Our leading indicators are pointing to that. When we move across to Australia, we think there's a high risk, not a central case, but a high risk of recession in Australia. And the reason we think recession is a high probability in the US and a high risk here is because inflation is so high and interest rates need to be increased to a level they haven't been at for quite a while. And this puts a dampening effect on economies, and often you end up with weak outcomes. So that's something to watch out for next year. In terms of the impact on markets, markets are already concerned about recession. So in relation to the US equity market's fallen about 25% from peak to trough. So it's already pricing a probability of recession next year. We don't think it's fully pricing the likelihood of recession, so there's likely some further downside there. In the case of Australia, if we did have a recession, equity markets would probably fall a bit further before they eventually bottomed out. But the positive, and I know that it's not easy to see a positive in the adverse investment environment we have today, but valuations have fallen. So on a forward-looking basis, on a medium-term basis, we're likely to get better returns from things like equities. So you're actually getting a better base from which to invest, which is a positive from a medium-term perspective.
Tim, thanks again today for presenting. I'm sure the members will really appreciate that and help them understand what's actually happening from an investment perspective. To the members, if you've got any further questions, please feel free to give us a call in the contact centre. Thanks again, and keep an eye out for our next update.